Our final presenter for this morning's session before morning tea is Jim Beyer, Managing Director and CEO of Regis Resources. Jim has been MD and CEO at Regis since October 2018. Jim's a mining engineer with a broad range of strategic, operating and startup experience encompassing more than 30 years across a range of commodities. Prior to joining Regis, Jim was CEO of ASX-listed Western Australian-based iron ore producer and explorer Mount Gibson Iron Limited. Jim, we look forward to the update on Regis. Thank you.
Yeah, thanks Duncan, and thanks everybody for joining me this morning, just before morning tea. And also thanks to the Diggers crew for the opportunity to talk again this year. Draw people's attention to the cautionary statements and I'll be making some comments on exploration targets as well. But for those that aren't familiar, Regis Resources is a gold producer with our producing asset sitting in Western Australia and a large undeveloped asset sitting over in New South Wales called McPhillamys. Duketon, it's got 3.3 million ounces in resource, and Tropicana, which we own a 30% share of, has 1.6% attributable ounces in resource, and you can see our combined reserves at 1.7. Duketon actually is a combination of three mills, one in the north, we call Duketon North, oddly enough, and the other one is in the south. There's two mills down there, and to remain consistent, we call them Duketon South. I'll talk about the guidance and how the outlook for those and how we're actually looking at running those operations, or certainly the Duketon piece, a little bit later on when I talk about guidance for this year. But if there's anything in this presentation that I really want to say or sort of draw attention to, and if you pulled up presentations from Regis for probably the last nine or 12 months, the material looks pretty much the same. It's just being updated for quarterly results. And the good thing is that what that really means is we just deliver. That's all we've been doing. We haven't been talking about anything, what we're going to do, we just deliver. And last year we delivered on production. There was a little bit, production and costs were at the good ends of guidance. Production was a little bit above midpoint towards the top at 373,000 ounces. Our all-in sustaining costs were sitting at 25.31. Both of those in the good parts of the range. Our growth capital was a little bit lower, partly because of some expenditure that we didn't get done at Rosemont South, one of Rosemont Stage 3, one of our underground development projects. But really that's a timing issue, and some of that's rolled into this year. Exploration came in, and McPhillamys was actually probably a little bit lighter than we originally gave guidance for at this time last year, primarily because of a reason that, unless you've been living under a rock, you'll know that the then Environment Minister decided to designate an area of our project as under Section 10 of the Aboriginal Torres Strait Islander Heritage Protection Act. And I'll talk about what the impacts of that are and what we're doing a little bit later on. So through the year, our cash and bullion was 517 million. We built 522 million, and we paid off through that the debt that we had this time last year of 300 million. Not only that, our underground reserves grew, and our cash flow is positive. And also, with the high gold price, we've been given and we're taking the opportunity to chase opportunistic ounces. So what does all of that mean in real language? Well, what it means is that this time last year, I stood in front of you and we were sitting with our balance sheet, had about negative $5 million on the balance sheet. And here we are 12 months later, and we've got $517 million sitting on the balance sheet. You can see the growth that we've been delivering, or the team has been delivering, quarter on quarter. We got rid of the hedges, probably the hedge book, the notorious hedge book. We got rid of that back in December 24. And apart from the wet weather impacts that we had in March last year, which I think everybody enjoyed, we've pinned our ears back and haven't looked back at all. We just continue to grow our cash flows. It has been a great performance and delivery by the team, at Regis. So what's our strategy? Well, again, another slide, pretty much the same as the last time, and 6 months ago and 12 months ago. Our plan is to establish Duketon, and which we have done, and our plan is to establish it so it can maintain out beyond 28-29, FY 28-29, to hold it in this 200 to 250,000 ounce range. It's not fully utilising our mills. We've got spare mill capacity in that. But that's basically our plan is to sit and operate in that well out into the next decade. Now, we don't have the reserves for that, but what we do have is a growing number of underground mines. We have a number of open pits, and we're running both open pits and undergrounds, but our real drive to be able to say that we can sustain that rate is to get 4 underground mines running. We've got 2 in operation, we're developing a 3rd, and we're chasing a 4th. And with those 4, we believe that we can sit in that 200 to 250,000 ounce range. Ideally, what we'd like to do as well is find another open pit like Garden Well or Tooheys Well or Rosemont, a million ounce sort of thing like Garden Well we finished this year, 1.4 million ounces we pulled out of that. So that'd be great to have on top of that, but that's in addition. We don't need that to maintain that rate. At Tropicana, we see production there, our share of production running through in this 125 to 140, 145,000 ounce range, out for the next, pardon me, probably 3 or 4 years or so while we're running the Havana open pit. And then in the absence of new open pit discoveries, which we think that there's some pretty exciting opportunities there, in the absence of that, it would still be a underground mine that I'll show you has got plenty of life left in the young thing yet. So turning a little bit now to the specifics of what Duketon looks like and what we're seeing from our undergrounds, and this really is our long-term story. So I spend a little bit of time talking about this. I mentioned before that we're chasing 4 underground mines. At the moment we've got 3, and you can see Rosemont, our first production was Rosemont Open underground, and we started there back in, production really started pretty much at the beginning of COVID in 2020, early 2020. We had a number of learnings that we needed to go through there, but that operation has now been consistent and positioned itself well. And not only that, what we're finding is, and we're understanding as we understand the ore body, we're able to follow it down. Orogenic, the ore's coming up from fluids down deep. It's not been transported in from somewhere that we're not sure about. We're just following that down. And this is the new stage 3 area which we've got under development, and we're already putting holes into this area that's further down plunge to the south and getting some very encouraging results from that area as well. Now the other mines that we've got are sitting underneath Garden Well South, which has been running for a couple of years. This is underneath the pit. That's Garden Well South area there on the left, and we're currently developing Garden Well Main, which we expect to be in production later on this year. So when we start an underground mine, why do we think that this thing can take, even though the reserves say you're only going to go out to 28 or FY 28, why do we think that it's got the potential to go beyond that? If you have a look at the story here, you can see that back in 2019, we started up with Rosemont, had reserves of 123,000 ounces. And here we are about 6 years later, our reserves still in the ground, still waiting to be mined, is nearly 4 times that, 441,000 ounces. And while we've been developing those ounces and drilling them out, we have produced nearly 360,000 ounces. Put that together, and what started off 6 years ago or 5 years ago as maybe being 120,000 ounces is now been between produced and what's still to go, at least 800,000. That's the story of the underground mining. And I could point you to a dozen at least of long-run underground mines that we all talk about. Earlier on, we were talking about Jundee. I mean, I saw in the paper, the local miner here has this news from 30 years ago, and there was the news of this new underground mine called Jundee. It opened 30 years ago, had about 3 million ounces of reserves, and 30 years later it's still got 3 million. And there are so many underground mines with that story, and our mines are following the same pattern. So that is what we see at Duketon. Our real drive there is to build that capacity up to plus 200, from the undergrounds. The open pits will give us bonus, but the undergrounds will deliver consistency and sustainability. Where could we get more from? Where's the fourth? Well, we're drilling underneath Ben Hur, which is a pit in production at the moment. Two is Wells, an old pit. We're drilling underneath that. We're also drilling underneath Bannergo. Basically, we can go to just about any of our old open pits and start looking underneath them to see whether they continue on in a manner. They all continue on. It's a question of whether they, apart from Mullart's deposits are transported in. We're not really sure where they come from yet. But they all come up. So we follow them down and try to work out whether they're economic or not. Now, will we get all three of these potential ones as a new underground? I doubt it. But I'd like to think at least one of them will come in. If I shifted to Tropicana, it's a very similar story, just on a much larger scale. So Tropicana is made up of open pit coming from Havana pit and the undergrounds, Boston Shaker, Tropicana, Havana underground. And it's a very similar story in terms of what's the life. Don't just look at the reserves, look beyond that. Back when we first went underground, there was nearly 320,000 ounces in 2018 in reserves. You jump forward to the last published reserves, we've now got 640,000 ounces underground. And during that time, from the underground, we've pulled 648,000 ounces. So what started off as something like 320 is now, between what's been produced and what we've still got, nearly 1.3 million. Nearly 1.3 million. And it's still all open. And the more holes we put in, the more we find. We put holes in where we expect to find it, and we find it. And sometimes we put in some holes where we don't expect to find it, or we didn't think it was, like in this concept area, and we find intercepts. This is a great deposit that will be going on for quite some time, certainly in the underground. And from an open pit perspective, as I said, we see Havana runs out in a few years' time, but we don't believe that that's the end of it. There's plenty of opportunity along strike, both nearby, places like Springbok, Hat-Trick, all the way up to Rosetta. This thing's got the potential to find another open pit. It's not in the reserves yet, but do I think that this will just be underground at the end of the decade? Not if some of the interesting work that we're doing and data that we're collecting from our open pit is anything to go by. But we have to watch and see. Tropicana is very much like Duketon in the way that it's structured in terms of production and outlook. The last is our asset, which is still sitting waiting to be developed. And I've had people sort of look and come and chat to me and say, why are you doing it? Why are you pushing on with the legal challenge? Because we're going to court, we're undertaking requesting a judicial review of the decision-making process, and we're expecting that to be heard later this year in December. But why bother? Why put our efforts into this and just potentially get frustrated? Well, if you sit down and do the maths, McPhillamys is a 1.7, 1.8 million ounce, well, it was a reserve, it's not anymore, but when it was, that's what it was, but it isn't now. Just need to be careful with my language on a number of fronts, actually. Jim, think, don't say. I think that's another thing. But it's a $1 billion project. But its average life of mine all-in sustaining cost is $1,600 an ounce. That was a year ago, so you'd probably say today it'd be $1,700. But that's average. So if it was running today, what would it be producing in terms of cash? Well, the first couple of years are certainly going to be a bit higher because we all know open pits in their early years run high strip ratios. That's probably going to be about, I don't know, $2,200, $2,300 an ounce. Spot gold price, $5,200. If this thing was running today, pre-tax, the cash flow on a daily basis would be, I don't know, somewhere between $1 and $1.5 million a day. So do I think it's worth pushing on and trying to figure out how we can get this thing done? Absolutely. Who wouldn't? There'd be plenty of companies that would bend over backwards to have this asset on their portfolio. We will work our way through this. There's a number of avenues. As I said, we're challenging it legally, but we've also got to get started and have a look and see if we can work a way where this can be developed with an alternative. Basically, the decision that was made by the minister at the time was the area that was currently the tailings dam is an area that has a heritage declaration over it, so we just can't travel on it. We can't go on it. We can't go over it. We can't even put power lines over the top of it. So we have to work out a way around it. And as I said last year when this all went down, this could take 5 years plus. But is it worthwhile pursuing? As I said, absolutely. So we will continue to work on the McPhillamys project as a medium-term project sitting in our background. But as you can see from the basic numbers, this is an absolute cracker of a project. We just need to work out how we can get it approved or in a way that allows us to basically to operate. So, apart from McPhillamys, what's our outlook? Well, I already talked through what Duketon looks like and what the basis of our logic is. And as mentioned before, one of the key elements of that is that we have 3 mills there. We have quite a substantial amount of milling capacity, and we're not utilising all of that all the time. And at Tropicana, well, we just continue on as I described it. So, we have a clear plan as to how we run the existing basis of our business. Our organic growth will come from the regional exploration around Duketon when we find a new open pit. But the other organic growth area is not so much increase in annual production, but it's increase in life and longer term value by adding another underground mine and just continuing to do what we've done for the last 5 or 6 years, is just add underground reserves. So what does that mean for next year and the next 12 months? Well, our group production is sitting pretty much, our guidance is pretty much the same as last year. The one thing that you will see is that our all-in sustaining costs have pushed up a little bit. And part of the reason for that is there's actually $170 of non-cash costs in that all-in sustaining. So if you're using the all-in sustaining to calculate cash costs, just make sure you understand how much of it is, if you're looking at different numbers from different organisations, make sure you understand whether the stockpiles are being built up or stockpiles are being drawn down. If stockpiles are being built up, it means costs actually don't get reported in the all-in sustaining and they go on the balance sheet. And if your stockpiles are being pulled down, it means that you've got non-cash costs coming from stuff that you spent years ago, but you still report it in the AISC. So in our AISC numbers, we've got about $170 an ounce that's actually non-cash. But the other thing that we've done, as I mentioned, we've got spare mill capacity and we know that the gold price is up. So we maintain our plans to mine our good high-grade material from underground and our good high-grade material from our existing pits. But what we've also done is we've gone out and we've looked for opportunistic ounces. Now they certainly cost a little bit more, but what would I rather do? Produce down here at a lower cost on average, or produce up here with some extra incremental ounces that still make damn good money at today's gold price? I mean, I'm not mining now, our company is not mining now for ounces that we want to get in 2 years' time. These are opportunistic ounces we can turn over within, in some cases, a matter of months. In some cases, it might be 12, 13 months. So that's what we're doing with our business. We're running our core of the underground and our reserves, but we're also using the spare mill capacity to chase those opportunistic ounces. Okay, so to wrap up, talk about the corniest of lines, a golden opportunity. $517 million in net cash and bullion at the beginning of the financial year. Clear ongoing cash generating capacity as we push on into this financial year. There's nothing too different this year from what we did last year. And just have a look at what we produced and put on our balance sheet last year. We continue to progress against our growth strategy and looking for new materials and adding profitable ounces, both long-term good value that'll survive in varying gold prices, but also opportunistic ounces. And we continue to deliver on our value accretive growth strategy. Future production opportunistic as well, continued demonstration of cash and profitable capabilities. We're in a dominant position with two highly prospective and very underexplored gold belts as well, with the Duketon and Albany Fraser Belt. So thanks very much for listening and appreciate your time.
Thanks, Jim. Quick question. You obviously very strong cash bill, well done. And you've talked a bit about your organic growth optionality. How do you think about sort of other ways to deploy cash, returns to shareholders, inorganic growth, just as part of the overall corporate strategy?
Yeah, look, a fair question. I think it's right to recognise that over the years, Regis Resources, certainly in the past when we had good cash flows, we were a regular payer of dividends. In fact, I think since 2012, Regis has paid over that was a drum roll in expectation of the number that I'm about to announce. That we've paid, historically, I need to be careful here, historically we paid over $500 million in dividends. We're in a strong position. I think it's safe to say that the board understands the reasons that companies are around, partly to grow, partly to return. And it will certainly be on the agenda of working through, is it dividends, is it buybacks, is it what other options and opportunities should we be considering? So it's definitely on the agenda for consideration, but at the end of the day, that's a decision that the board will make, certainly as part of thinking about what's the right thing to do and what other applications might we have for that capital. But certainly it's great to be in a position where we see the last 12 months has been clearly a very strong cash generating business, and nothing looking forward is going to change that in the near term.
Thanks, Jim.